Right now, in July 2026, the global airline industry is experiencing the most dramatic split in its modern history. Some carriers are posting the biggest profits they have ever recorded, billions of euros and dollars flowing straight to the bottom line, whilst others are hemorrhaging cash at an alarming rate. What is driving this extraordinary divide? A single word: Iran. The ongoing conflict in the region has sent oil prices surging, and because jet fuel typically accounts for 20 to 30% of an airline's total operating costs, the winners and losers are being sorted with brutal efficiency. Welcome to the story of how war, oil, and airline strategy are colliding head-on in mid-2026, and why it matters to every single one of us who has ever bought a plane ticket. Since the Iran conflict escalated earlier this year, crude oil prices have climbed sharply. Major energy companies like Shell have reported surging profits as a direct consequence of tighter global supply. Shell's results published in early July 2026 made for stark reading, confirming that war in the Middle East is translating into enormous revenues for the energy sector. For airlines, this creates a brutal cost problem. Fuel is the single largest variable expense on any carrier's balance sheet, and when oil prices spike without warning, those without robust forward hedging agreements find themselves exposed to spot market rates that are genuinely ruinous. What this conflict has done is create a live, real-world stress test for the entire global aviation industry, separating the financially disciplined from the vulnerable with unforgiving precision. Perhaps the most remarkable story of this turbulent period belongs to Ryanair. The Irish low-cost carrier has reported a staggering 40% surge in annual profits, reaching €2.26 billion, figures that would be impressive in the calmest market environment imaginable, let alone one characterized by war-driven fuel costs and ongoing Boeing delivery delays. So how has Ryanair pulled this off? The answer lies in three disciplines executed simultaneously: aggressive long-horizon fuel hedging that locked in costs well below today's spot prices, relentless operational cost control that squeezes waste from every corner of the business, and careful capacity management that kept load factors high whilst allowing fares to rise. Ryanair has demonstrated in 2026 that structural cost advantage, built patiently over decades, provides a form of financial armor that rivals simply cannot replicate overnight. Across the Atlantic, the contest between America's two great premium carriers, Delta and United, is generating considerable excitement on Wall Street. Both airlines posted strong second-quarter earnings in July 2026, prompting analysts and investors to ask the obvious question: which stock now offers the better opportunity? United has drawn strength from its commanding position on transatlantic routes, where premium cabin demand has held up remarkably well despite the broader geopolitical uncertainty. Delta, meanwhile, has capitalized on deep corporate travel relationships and the formidable recurring revenues generated by its loyalty program. The shared headline story for both, however, is historic. They have effectively erased every dollar of the enormous pandemic-era losses that once made airline investing look like financial self-harm. The sector's rehabilitation in the eyes of the market is now essentially complete. Not every airline is celebrating, however. EasyJet, the British budget carrier, has reported deepening losses, a picture in almost direct opposition to Ryanair's triumphant results. For EasyJet, the Iran war has delivered a double blow: rising fuel costs driven by oil price inflation, and weakening bookings from leisure passengers who are growing increasingly cautious about traveling through or near regions of instability. Unlike Ryanair, EasyJet has historically maintained smaller hedging buffers and operates on a model more heavily dependent on the ebbs and flows of leisure demand. The result is a carrier caught between rising costs it cannot easily absorb and a passenger base that is proving more reluctant than usual to commit to bookings. This divergence, one budget carrier posting record billions whilst another posts deepening losses, delivers a critical lesson: in aviation, low cost does not mean crisis-proof. The financial markets have been tracking these developments with intense interest. Across the U.S. airline sector, stocks have staged a remarkable run in 2026, with the industry as a whole now having erased the pandemic-era losses that once made these shares a cautionary tale for retail investors. The partial easing of oil prices from their sharpest peaks, even as the Iran conflict continues, has provided sufficient breathing room to sustain investor confidence in the near term. As of today, the 18th of July, 2026, market sentiment towards the sector is one of cautious optimism, with the emphasis placed firmly on carriers possessing strong balance sheets, premium route networks, and genuine fuel cost discipline. However, seasoned analysts are unanimous in stressing that the geopolitical picture remains fragile. A renewed escalation or fresh disruption to Middle Eastern flight corridors could reverse recent gains with very little warning. One of the less discussed but deeply significant consequences of the Iran conflict is its physical impact on global flight routes. Long-haul carriers that have historically relied on Persian Gulf overflight corridors, those vital pathways that connect European capitals to Asian hubs and Australian cities, are now being compelled to reroute around restricted and contested airspace. Each added hour of flying burns additional fuel, incurs extra crew costs, and creates scheduling complications that ripple across entire networks. This situation carries strong echoes of what happened when Russia's invasion of Ukraine closed vast swathes of Eastern European airspace from 2022 onwards, a disruption that added hundreds of millions in cumulative costs to European carriers over the following years. The geopolitical map of commercial aviation is being physically redrawn in real time, and the financial consequences are only beginning to be fully calculated. For ordinary travelers, the picture emerging from the summer of 2026 is genuinely mixed. If you are flying with a premium carrier on a major European or transatlantic route, prices have remained broadly stable. Intense competition on those corridors continues to limit how aggressively airlines can raise fares. But if you are booking with a budget carrier, particularly on routes affected by regional instability or that now require longer, more fuel-intensive diversions, expect elevated prices and tighter seat availability compared with previous summers. The data being published this month tells a consistent story. Premium cabin bookings have held exceptionally well, suggesting that higher-income travelers are largely insulated from geopolitical anxiety. Leisure travelers, by contrast, are displaying greater price sensitivity, booking later than usual, and in some cases delaying or canceling trips. Airlines are watching autumn booking curves with unusually close attention, knowing that a further oil price spike could shift demand sharply and swiftly. The story of the global airline industry in July 2026 is ultimately a story about resilience, strategy, and the unforgiving economics of an industry that cannot insulate itself from the price of oil. Ryanair's €2.26 billion profit and the record quarters delivered by Delta and United demonstrate that the industry's best-run operators have learned, at great cost, over many hard years, how to build businesses that can absorb external shocks and still emerge stronger. EasyJet's struggles serve as a clear and sobering reminder that not every carrier has the same financial architecture or strategic depth. What the Iran conflict has done, above all else, is accelerate a sorting process that was already quietly underway, separating airlines with genuine, durable competitive advantages from those that were simply riding the post-pandemic wave of pent-up travel demand. This industry is more interesting, and more consequential, than it has been in years. If you want to stay ahead of these developments, subscribe now and hit the notification bell. There is a great deal more analysis on its way.